The stock market returns follow earnings over the long term. They roughly follow earnings.
Yeah.
Roughly.
Okay.
Roughly.
But
Yeah.
no, so do I need to get bumper stickers printed that say complex adaptive system?
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
What a difference a year makes. We're going to say this
What does
every
that
year.
mean?
It means last year and then this year. What's in between is the difference. And what a difference that makes.
And last year was 2021. This year's 2022. It's amazing.
Oh my goodness.
So different.
Can you imagine? Next year, you're going to be telling me it's 2023. Next year, you're going to be telling me it's 2023.
Get to your point already, Doogles.
My broad point, so we're coming up on year end here. And my broad point is so much has happened this year. I'm going to go out on a limb. I'm going to say this was an exciting year. I won't say it was an excellent year, but I'll say it was exciting.
I know what you're doing.
And
here,
I will say
it's not even funny.
Exceptional. Anyway, all right.
I have an egg question for you.
That's not even a, I don't know whatever you call it.
I'm not as clever as you.
So the whole thing here is there's a lot of reasons. And when we do our year recap, which is probably going to come out next week or the week after, when we do that year recap, we'll talk more about the year stuff. But what I want to talk about right now is the number one grocery item from a price increase perspective year over year is what? Eggs. It is eggs. Here's why you should
49%.
49% up this year. In comparison, let me give you a couple comparisons. Lettuce up about what? 20%?
You mean the former prime minister of Great Britain there?
Yes,
What?
aka lettuce.
Okay.
Cereals and bakery products, which should not be lumped together, but they are here. 16%.
Grain-based. I mean, I get it.
Yep. Milk, 15%. So anyway, 49%. And this is kind of wild. Now, yesterday, my wife was out at the grocery store doing what you do at grocery stores, which is grocery shopping. And she sees an virtually empty shelf in the egg department. I don't do this thing called grocery shopping because I don't understand what these stores are for, what you do in them. But what I do is I read all these articles and whatnot. And so my response, she sent me a picture of the empty shelf. My response was I sent her this article for her to read in the grocery store. I don't know why I'm sending this article about what's happening with eggs, because this is actually like a meaningful event, what's happening with eggs right now. And it's not just the price of eggs. Do you know why it's meaningful?
I have no clue where you're going with this.
I hope people care about this because I think it's important. So we had an avian flu this year. Avian equals birds.
Different than COVID.
Yes, there's an avian flu this year. The last time there was an avian flu was in 2015 in the United States of America. It was in 2015, real bad in 2015. And the reason why in this country, at least, people likely even know the term bird flu, avian flu is because of 2015, because it didn't really happen for a decade, 2 decades, multi-decades before then. But this one's real bad. I'm going to give you a couple numbers. And this is the main reason why eggs are so high. Actually, quiz. Real bad, worst in U.S. history, avian flu. How many birds do you believe passed? 2022.
15 million.
57.8 million birds.
I mean, I feel like you're going to get us off task here. You can't talk about avian flus and the price of eggs without talking about some of the questionable farming practices and the birds being lumped into massive warehouses.
Yes, I can, and I will. So this is a lot of birds, right? But here's what I didn't. We can get off this. I think it's like real meaningful because in 2020.
Hold on, though. Is the fact that a lot of this is done in massive warehouses where I think you can have more than a million birds in a single spot, if not significantly more than that, playing a significant role here? Do you know that?
I'm pretty sure. I don't know for sure, but I'm pretty sure it is because the avian flu is very contagious.
Yeah.
And so how could that not? And it's super deadly. So when I say super deadly, 90 to 100% of chickens die when they get the avian flu. Thing? Yeah, within 48 hours.
My goodness.
Yeah, it's massive, right? And so then the thing with 2022, and many things happen many years, but if you extend 2020 to 2022, we can even just talk about 2022. There's just so many things that are occurring that something like the largest avian flu in U.S. history doesn't even like hit the radar, because we got Putin up in Ukraine, right? We've got all the supply chain shocks. We've got inflation. We have the stock market falling apart, and 60 million birds are like, what about us?
Yeah. What's crazy though is I knew the price was up. Like in my local grocery store, they're rationing eggs. But to your point, I didn't know why. I assumed this was some other COVID related supply chain nonsense, right? This is almost an entirely different thing that, because of how crazy this year is, this goes exactly to your point, just gets lost in the shuffle.
Yes, exactly. And I'm going to close on this, is in the same graph that shows the like percent change year over year for a bunch of products. Consumers are in trouble because at the bottom of this are items that are losing price, like going down in price. Smartphones down 23%. Television's down 17%. And I know that there are people, and I'm warning against this right now, there are people that are going to go, I guess I should buy less eggs and buy more televisions. And that is not what is happening here. This gets back to your whole like Black Friday thing, right? Just because something costs less doesn't mean you buy more of it. You should not buy more smartphones and more TVs and less eggs. Do not do this.
I mean, I could kind of get behind that. TVs are more exciting than eggs. If you don't have to put calories in your body. I mean,
true.
Go for it.
All right.
Yeah. The last thing on that graph, we had a debate about airfares a while back, and unfortunately it looks like Doogles is right. Airfares are up 36%.
And we won't even go down the Southwest train. There are many podcasts you can listen to that will talk about the Southwest debacle right now. But and for Southwest is like the epitome of well operating machines in the airfare world. So anyway, all right, let's change topics. Yeah,
fascinating stuff. So I know we're going to talk SPACs in a little bit. Let me squeeze one thing in, if you don't mind. I sent you a video this week. It was taken from mid-year 2022, and it simply is a TikTok where a guy goes around and interviews used car and new car salespeople and talks about their monthly payment for their cars. Now, I'm sure this is cherry picked, but there's maybe 10 people in this video, and all of the monthly payments were north of $800. This is a monthly payment for a car. They were between $800 and $1,500 a month, if I remember correctly. I am still shocked by this.
And people with multiple cars, that's like one of their car payments.
Yeah. They go, oh, which one? There was an individual that had an $1,100 a month car payment for one car and a $1,300 a month payment for another car. It doesn't take rocket science to figure out that that's $2,400 a month, which can be a nice size mortgage. I mean, I know a lot of people, myself included, that are paying less than that for a place to live, let alone have two cars.
The bigger those, so the absolute dollars, big. And what's even more meaningful is the percent of income, right?
Yes.
Of what payments are, which they didn't talk about here. But I can tell you, just from watching this video, they did not walk into like Goldman Sachs office and walk up to the partner floor and talk to folks. This is like they found somebody in the back of the Dollar Tree. Like,
this is not C-level. No, I honestly think most of these people sell cars for a living, and that's a honorable profession. Well, I don't know about the profession, but it's fine. It's not C-level compensation figures. Let's just say that. So first, just a sanity check. Am I just completely out of touch? Is this more common than I realized, Doogles?
I have no idea. There must be something out there that shows the average car payment. I might, even while we're talking here, I might Google that and bring it up a little bit later if I can find it. Because I don't know. I was surprised when you first sent this to me and they were like, what's your average car payment? I expected maybe the high end, given like that they weren't talking to people that work at Goldman. I thought the high end might be 800 or something, not multiple cars at over $1,000 a pop. Like that was very surprising to me. So I do not know what the average is, how common this is, but I'd love to see a histogram, something like that.
Exactly. This quick research here looks like the average monthly car payment for a brand new vehicle at the end of Q3 was about $700 a month. That's what I thought was the high end of fare, and an average for a used one is 500. I mean, I guess I'm stuck in the past here. I remember maybe a decade ago when it seemed nearly impossible to spend $500 a month on a car if you financed it. Just absolutely crazy. I think what really has me fired up about this is cars are such a depreciating asset that if you're spending $1,500 a month somewhere, like, can you imagine if you're buying $1,500 a month worth of stock and driving a 20-year-old Honda Civic, how much better your financial life looks if you do that? I mean, this might just turn into a rant for me, so we can move on, but I am just absolutely shocked by this video.
All right. I'm doing some other quick math. Now we are like taking quick research, assumptions on assumptions and assumptions here, but
yeah,
I'm gonna throw this out because this is important, right? We talked about it's the percent of household income that ends up mattering the most.
Yes.
Right. Okay. So I don't know where this falls, but here you go. You said $700 ish, right? Is the average car payment. On average in the US, my quick research shows there's 1.88 cars per household, right?
Yeah.
So you're looking at somewhere between $1,300 and $1,400 a month on cars. And if you go to the median household or average household income in the US, it's about $70,000 for a household. So if we do 1,300 divided by 70,000,
1,300 times 12.
Oh, oops.
15,600. No. So I'm doing it. So 15,000.
It's like 25%.
22. So, okay. Granted, I hope most people don't have two brand new cars. I hope you have one paid off or something. But yeah, that's my point exactly. The old school conservative math for a mortgage is 25% of income, right? And you have people spending that on cars. And you know what? It was even more incredible. These cars were not like cutting edge Mercedes or Teslas. In most cases, the actual model, and it was a big truck or something. I mean,
yeah,
we got to move
consumers
on.
are in trouble between the eggs and the cars. Consumers are in trouble.
I don't get it. I can't even fathom this one.
All right, you want to go next? Want me to go next?
Go for it.
Okay. I'm gonna do twofer. There's a little bit of a twofer here. They're two separate topics, but falling under the same umbrella. And that umbrella is what you like to call mean reversion. I like to call a bunch of nonsense coming back to sense. There are items that we have discussed a few times, right, over the past couple years. They got out of whack, out of control, and now are at least coming back down a little bit to earth. They're not back down to earth yet, but a little bit to earth. The first one we can talk about is what you mentioned before, which is SPACs, special purpose acquisition companies. These are organizations, like you can think of them like holding companies, right? They are empty shells of companies that are put together for the purpose of buying another company. And in recent history, more specifically, to buy another company, to take that company public without that other company having to go through all of the due diligence, et cetera, that you don't normally have to go through for an IPO. So over the past couple of years, you want to step in?
These are sometimes called blank check companies because you go to investors and say, write me a check, and then I will go find the company that we will acquire and take public. It's very unusual. Typically, like this basically never happened until late 2020 into 2021. The track record of these companies has been terrible. Almost without fail, you lose money.
Yes, pretty much. And I'm going to clarify something about what you just said in a second, because it's right, but there's a nuance to it. So when you say basically never happened. There would be SPACs came about, I think, like about 30 years ago, like kind of in any real form, but it was pretty rare. Didn't really occur. In the last 20 years, you might get like tens, sometimes one a year that would take a company public. In 2020, 248 companies went public via SPACs. In 2021, 613 companies went public via SPACs. So you're talking like 10 to 20 to 30 to 600x, depending on the year that you use as a baseline, the number of companies that are going public by SPAC.
It was a clear sign. It was a real-time indicator of a bubble.
Yes.
And some people called it, and others thought it was this brave new world. Yeah, and you're going to tell us some facts now about how it probably wasn't a brave new world.
Yes, it was not a brave new world. And we were a couple people that talked about this and called it. And we had an episode called The Road to a Spectacular Disaster back in, was that 2021? Was that last year that we talked about that? Probably.
Yeah,
it was. It must have been. And so one other fact before we get into some of the detail of what's happening now is that typically SPACs have something like a 2-year lifespan. Like they're given money and they have about 2 years to find a company to take public, right? So there's a clock that's running on that organization. So right now, there are about 70 of these SPACs that have liquidated and returned money to investors since the start of December. That is a lot. So 70. Okay. That is more, according to the Wall Street Journal, that is more than the total number of SPAC liquidations in the history of the market.
So great.
Like, so in December of 2022, more SPACs have liquidated and returned money to their investors than ever before. And this is going to get to your losing money piece, because this is really important. So SPAC creators have lost more than $600 million in liquidations this month and more than $1.1 billion this year. However, what's most important, and this is the nuance I want to throw out from what you were saying earlier, is the people that lose money are typically the investors and the secondary, I'll call it, investors in the SPACs, and not the creators. So while the creators have lost $600 million this month, $1.1 billion this year, they already made the bulk of their money when the SPAC took the company public in the first place. So I don't have numbers on this, but like from what I see in this journal article, and it makes sense to me, is that like that $600 million, that 1.1 billion is like not even, it's like chump change compared to the quote unquote fortunes that have been made. Chamath, one of your best friends, Chamath, he's shutting down a couple SPACs. He shut down a couple SPACs in September. He said his firm made $750 million across the deals otherwise. So
yeah, so
people are making money.
I don't want to go, I'm not an expert on this. And so just to provide a little context, effectively the way this works is when you raise money, the person that brings all the investors together gets a huge cut off the top. And typically you can take a company public regardless of the future performance of that company and get, I think it's as much as 20% of the raise, but it's millions and millions of dollars, in some case more. So it is a blank check company where the organizing party almost has a win-win proposition, and everyone else, the other investors, have a proposition that is likely to lose. Like it would be upset to find a way to make money with this long term. Hopefully we never see another boom like this, because it's not good for investors.
Agreed. And it's similar to the conversation that we had either last week or the week before, when we were saying that when you see that there's a quote unquote great investor, big name investor, I should call it, big name investor that's out there that has quote unquote skin in the game, you don't know what skin they have out of the game. Even if you see a big name investor or just a famous person that has a SPAC that's out there, if they already took $1 billion off the table, them having $100 million on the table doesn't really tell you a lot. Mm-hmm. And so it might feel as if like, oh, we're on this together, but they're not, per what Skippy was just saying there. And this reminds me of The Walking Dead here. You watch The Walking Dead?
No.
Okay, well, you can just picture a bunch of dead people walking around. There are almost 400 SPACs holding about $100 billion that are out there looking for deals still currently. Mm-hmm. And in the environment that we're in right now is one where valuations have been hit really hard. a bunch of the good stuff was probably taken 2 years ago. The quote unquote good stuff, right, was taken a couple years ago. So you're looking for garbage. There's $100 billion out there looking amongst the trash heap.
Yep.
No offense to if you're still out there, because the non-trash heap, and this is another big point. The folks that, like the private companies that are out there right now that are quality, are not looking to be bought by a SPAC. Like they will probably refuse to be bought by a SPAC. And so SPACs are limited to the organizations that are likely a bit more desperate, need liquidation or liquidity of some sort. And so the $100 billion looking for question mark. That's a big statement I'm making, but I'm going to make it.
Yeah. I wish I had done another deep dive, because when we talked about specs previously, I kind of did a lot of research here. And so from memory, I'm worried I'm going to mess this up. But in some cases, I think the incentives work for the organizing party where they make more money if they take something public, even if what they take is public is complete garbage. So that incentive piece has me even more worried about the money that is still out there. I think in some cases you could have bad actors say, I don't care what it is. I mean, to your point, if you're a profitable, well-capitalized company, you probably don't want to go public with a SPAC anyway, especially in this environment. So I hope that doesn't happen. I hope at this point people realize that this was probably a poor decision, give money back to investors, and move forward.
Last point before we move on to the second part of the nonsense becoming sense is, if you look at the average valuations of companies going public via SPAC, go back to, this looks like it's Q2 or Q3 of 2021, almost $3 billion was the average valuation of a company. Yep. Now it's more like $200 million to $300 million. So it's about a 90% cut, roughly. I'm eyeballing this off of this graph here, but 90% cut. It is drastic. Okay, this one will be even shorter. You got anything else on SPACs before I?
No.
Over? Okay, this one will be even shorter. Nonsense coming to sense. All right, January 2021. We were talking about the meme craze. The meme craze. Everybody talking about the meme craze, right? AMC was one of those stocks that got caught up in meme mania, and by caught up, greatly benefited and is surviving today because of. I should say they're in no way, shape, or form a victim of the meme craze. January 4th, 2021. That was the first day of stock trading in 2021. AMC opened at $2.20. December 30th of 2022, last trading day, 2022. AMC closed at $4.07, up 92%. If all you did, you put the money into AMC at the beginning, you fell asleep, Rip Van Winkle, and then woke up a couple years later, be like, cool, right? Like that's some hotness. I made my good choices. Go back to sleep. But the 2021 high for AMC, $64.96. So at one point, AMC was up 2,695%. I don't even know what to.
This is for the New York Times, for their year in review, had a bunch of charts, right? Just, this is how the S&P performed versus the NASDAQ versus crypto. And on their chart, they just cut off the bottom at 40%. And like in the middle of the year, crypto just falls off the chart, right? This is what you need with AMC too, is like, if you're comparing it with anything, it just either goes off the chart to the top or off the chart to the bottom, because the performance is spectacular. And in some cases, spectacularly bad. Seems like AMC's actually come back to earth.
For the most part. I mean, the only thing you can say where they haven't is still up almost double. Now, to be fair, at the end of 2020, AMC was on its last legs. Like, so you could say that today, that company should be worth twice as much as it was then, because at that point in time, its survival was completely questionable. Whereas now it's only questionable and not completely questionable.
Yeah, it's still, I mean, I don't know the prospects of the mining company they purchased. This is a good opportunity to tell my favorite story in the past 2 years. AMC, during the height of this craze, their management team, meaning their CEO and their CFO, basically sold all their stock. And those guys are clearly smart because they knew it wasn't worth this. And then the company issued a statement when they were issuing more stock to the public markets to raise money. And they issued a statement that said, this stock is worthless. Do not buy it. Our company has basically no prospects of success. Most amazing thing. I've never seen another company do it. I hope a company never does it again. They, with straight faces, they sold equity to shareholders and said it's worth $0. So good.
It's kind of to the reason why you love this story, I think, or at least the reason why I love it, and I think this is part of it, is it speaks completely to the times where I can give you something. I say, Skippy, here's a pen. You know the old like sell me a pen thing from is whatever, some big play
interview
back in the
for
day.
a sales job.
Yeah.
Sell me a pen. Yeah.
Sell me a pen. If I went, this pen's absolutely worthless. $40. And you went, oh yeah, do you have two? Like that is what was happening.
Let me run to the car. I have 10.
Yeah.
Here you go.
What was happening right then, right? It's like, and how do you, as a company, you got to be scratching your head and be like, how, as a human being, I cannot morally justify what I'm about to offer. And as a person that has a fiduciary responsibility to this company, I have to offer more. Like,
no, so that's the most interesting thing is if I have my corporate finance business strategy hat on, I almost want to applaud the leadership team at that point in time. If you have like your moral human hat on, it seems like what they're doing is questionable. And I honestly don't know, because they do have a responsibility to their shareholders. Like, I honestly don't know where that line is and if they made a right decision. But they did come out and clearly say, we think this is effectively worthless and you should not buy it. People still bought it.
What are you gonna do? All right. You got Fishbolio?
Just one thing real quick. So a lot of shops, a lot of investment research shops do 10-year projections based on current valuations. And those projections for future performance 10 years out tend to be pretty solid. We talk a lot on the show about predictions and forecasts and how you shouldn't rely on them and how poor they are. The one caveat to that is probably if you're doing something that's 7 to 10 years out, it tends to be pretty reliable because long-term performance of the stock market is fairly predictable based on valuations. Short-term is just a coin flip. So whether it's GMO or research affiliates or other ones, the 10-year projections for US equities, this is like the S&P 500, right now was negative at the most recent peak just a couple months back. And now as stock market valuations have come down, as the valuation of the S&P 500 has come down, to say that more articulately, return projections look like they're in the range of 4% a year for the next 10 years. What's fascinating to me about this is simply the thought experiment here, right? One, I'm not holding just the S&P 500 because I believe in buying based on valuation. So the stuff I'm buying should have much greater return expectations than 4% a year. But your average investor might be. And where do US treasuries sit right now? Doogles, right at about 4%.
Yep.
So we're at a tipping point where we haven't been in recent times, where an investor could say, listen, I can hold the S&P 500 and probably over the next 10 years, I'll make 4% a year. Or I can say, I don't want to do that crazy roller coaster ride, manage my emotions. I can buy something that's much safer and much less volatile and end up in a similar place.
What's bizarre, because we're all humans, is that there's a roller coaster ride in both directions. One roller coaster ride has to do with what you do hold, which is when you're buying out in the market. The other roller coaster ride has to do with what you don't hold. Owning treasuries when your friend next door owns AMC going up 2,600% is also really difficult. And so just know yourself before you choose what direction. But I also, going back to your point, it is fascinating. It's really fascinating. And 4% quote unquote guaranteed, 4 to 5% quote unquote guaranteed is pretty solid, depending on age, risk tolerance, etc. But it's not what it was a year ago, 0%. Like when there was remember when Tina was strutting around? Like,
yep,
it's not even close to that.
Man, Tina was on the prowl. There was nothing else to do with your money. And that's why AMC was going up like this. I mean, it's crazy how different that is just from the mentality piece, because 18 months ago, there was really no other play. This is why you had BlackRock buying subdivisions, right? Just like 300 houses at a time, because they didn't have anywhere else to put their money. And now those investments don't look so great. So it's a brave new world on that front. I can't wait to watch interest rates in 2023. But I think I mentioned it 2 weeks back. Just know that we're in a different spot. And if you had a hard time managing your emotions through the roller coaster ride of 2022, there might be a way to recalibrate that helps you sleep at night.
Word. Okay, I got one last thing in the fishbowl before we hit the last listener mail of 20 deuce.
There you go again.
Yeah, there you go. All right, last thing, and this has to do with predictions as well. James McIntosh came out with an article in the Journal.
Our boy,
James like McIntosh. little bit more legitimately. Our boy
joined us from London. He's the man.
He is. Came out with this article, the Wall Street Journal, called "Wall Street Nailed Earnings but Missed the Bear Market," and it's a really short and like simple piece, and I think it's kind of awesome because the way that this article starts, if it just started this way and had nothing else, it'd be brilliant. Here it goes. If I told you that a group of really smart people in Wall Street were able to predict exactly how much money America's biggest companies would make a year from now, you might think they could tell us where the stock market would go. Not so much. So for the first time on record, the record goes back a little under 30 years. For the first time on record, the earnings consensus for the stock market in the US, this might just be S&P 500. Yeah, S&P 500.
Yeah, it is.
Was like right on point. The consensus was $221 per share, and it was off by like $1, I think, something like that. It was like right on point. And it's usually off by 10, 20%, in the positive, negative, something like that. Right on point, like nailed. They said, we know how much the companies are going to make. And going to your long-term point, if you look at the graph of the stock market over the long term in the US, the stock market returns follow earnings over the long term. They roughly follow earnings.
Yeah.
Roughly.
Okay.
Roughly.
But yeah. No, so do I need to get bumper stickers printed that say complex adaptive system? You're exactly right. They said $221 in earnings for the S&P 500. All the companies there. That's basically exactly what we got. What changed is the multiples. Like,
yes,
we're not at a PE of 30, meaning a price to earnings ratio of 30 times. We came down. So even if you get one piece of this complex equation with millions of actors right, the chances that you get all those things right is basically impossible. Or if you do, it's just luck. It's not based on skill. So I love James because he like really, really knows his stuff. That's evident in the interview we did with him. But I also love him because he can distill this down and say, like, this is the problem with thinking that you have the game figured out. Like, it's too complex for that.
Yep.
This is a really amazing piece. And even like the little graph he has, it shows how far you alluded this, but it shows how far they're typically been off. And they've been off by as much as 30% either direction. Well, there's 5 years here where they've effectively pegged it, meaning less than 3% error. But that's just one piece of this really complex equation.
And speaking of multiples, and this, maybe you're going to call nonsense on me, but this to me feels so wild. The average forecast for what interest rates would be this month in December of 2022.
Yeah.
The average forecast from last December, so December 2021, was 0.5%. What?
Those are just those are just garbage, man. Haven't you seen there's this really cool graph that shows what interest rates actually do versus forecasts, but they update the forecast like every quarter. And it always shows interest rates going back to previous average, basically. So right now, where interest rates have been low for a really long time, it always shows them just going back to what we're used to, which is 0.5%. They are so consistently wrong. It's almost unbelievable.
Oh, love this piece. We'll have it on the Substack Monday for you all. So good. Thank you, James. Okay. Is it time for the jingle?
Oh, give us some listener mail.
Here we go.
They fight and fight and fight and fight and fight. Fight, 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 fight. The Skippy and Doogles show.
All right, 2 pieces today from Liz and John. Liz had a really in-depth question, lots of thoughts about reading a recommendation and potentially diversifying your investment risk by starting a business. Doogles, I don't know that we can do this justice in a short period of time. There's a lot of nuance here. I know I've mentioned on the show that I started a new business in 2022. Super excited about that and feel like it was the right choice for me. But I think it's really independent decision based on a lot of what's happening in your financial picture and what your potential skill set and opportunities look like. So I don't know that I can do it justice. Can you?
I don't know about justice, but we can answer. I think we can both at least answer the questions. The first question that Liz has, which is, how did you decide to do it? I think that question is more straightforward. And to your justice point, the second question, which is around how do you think about balancing that with your family income, your personal income, and that one's highly nuanced, but we can touch on it. One other thing I think is interesting is on the how you decided to do it, where from my own life experience, where you are in life in your career changes the answer to that question, at least for me. So when I started my company, it was about 10 years ago. It's wild to think about that, but it was about 10 years ago. And at the time, to vastly oversimplify, there were 2 key elements to it. One was there was a problem, like a world problem that was eating at me, that I've been thinking about for the last the 2 to 3 years before that, and wanted to solve. That was a big one. And one thing since then that I think that I'll say, or I've discovered, realized, or currently believe, is that a problem continuing to either eat at you or just you think about is an important component. And also 2 to 3 years isn't that long. At the time I was this has been eating at me for 2 to 3 years. There's as I think about current problems that have been eating at me for a while, it's 2 decades, something I might have been thinking about, or 15 years, it's a longer period of time. But at the time there was that. It was a problem that was eating at me. And the second point was I really wanted to control the destiny of whatever company solved that problem. It was really important to me that it was a high growth, large ownership, could become big type of company at the time, which more influenced the type of company I started more so than probably the fact that I started it. But for me, there was a problem I wanted to solve. So that's the answer to the first question for me.
So Liz, for me, the reason I decided to take the jump and start my own business is because as you study businesses, and if you're someone who's as interested in finance and investing as both Doogles and I are, you start to realize that the people that get rewarded most for a business's success are the owners of the business, right? And so I had worked in the corporate world in various roles in financial strategy, where I had seen, huge impacts of my work and my team, but I didn't always see the rewards of that, really challenging, stressful, hard work. And I got to a point where it was clear to me that I was ready to bet on myself and hopefully, if my business succeeds, receive some of those rewards, while at the same time kind of doing it my way, right? Stepping away from the corporate culture and having more freedom to make decisions and be accountable to the decisions that I make with my own company. So that's kind of where I got, and why I still am really excited about the future, because I'll tell you, whether you read a book like The Millionaire Next Door or anything else, this aspect of business ownership is a key piece to wealth in this country.
It goes back to R is greater than G, the Thomas Piketty, right? I'm telling
Doogles
you,
loves it. Doogles
I'm telling you, that'll be in a book recommendation when we send it out too. Yeah, I think it's a really big point. And to answer the second question around balancing incomes, investments, other stuff, this is a vastly oversimplified statement for me, but to me, it's related to what you were just saying. And it has to do with point in life for me is when I started the company 10 years ago, there was no balance. It was like, this is the bet. And I'm talking like taking money out of 401ks, going into credit card debt. Like it was like everything was going into the business. And there was a part of it was like a risk reward. Like I was earlier in both my career and just family life. And there's a risk reward associated with that. Now, if I decided to do it again, it'd be different. Like I have the foundation now. The reward, like I don't need that big reward. Like that isn't the thing I'm gonna like risk everything for, or at least not as I sit right now. So it's more right now, there'd be more of a balance. It's thinking about what does savings look like? Do we still have that emergency savings? How much can we eat into that? What would income look like? And the reward would be, I won't even say lower financially, but like more long-term financially. Like it'd be spread out over a longer period of time. And the reward for me would have a lot more to do with where I spend my time and the ROI on time, and me feeling like I can have the balance that I'd want and still do the thing that I want and not do the other stuff that I don't want to do, right? Like that would have a lot more to do with it. But that all depends on, for me, life circumstance. And so that's like a really oversimplified answer for me.
No, it's funny. I mean, I'll reveal a few of your secrets, Doogles. Doogles did the Silicon Valley startup thing, even from the sense of he was in San Francisco at the time, right? When I started my business, I did it my way, and it's maybe more of a value investor way, but it's core to my philosophy. Like I had a lot of money saved. I had clients lined up. I had an area where I felt and I feel like it's a true win-win, and everyone is better off when my business is involved. That's like core to my beliefs. So it's less risky, hopefully, but also, yeah, my upside is probably limited.
So those are the short, simplified answers. Hope they're helpful. Feel free to follow up. Maybe off pod, if you do follow up Liz, we can give some other written responses back to you if they're helpful, but hope that's helpful. All right, what's number 2?
I love that you're thinking about it, because life is short. So if you have an itch that you got to scratch, I mean, very rarely do you end up with significant regrets about picking up new skills, starting a new business, those sort of things. It's a great learning experience.
All right, John.
Oh, John, thank you so much for the listener mail. This one goes, hey, the nightly news tells me that inflation went up 7.1%. And so if I didn't get a raise of 7.1% this year, I'm worse off and the world is ending. Am I being a little too dramatic with that recap, Doogles?
Probably, but I understand why.
This is what I call first grade journalism. This is so short-sighted. And I guess I got fired up because I just saw this. We got the listener mail from John midweek, and then I was just down. The news was on in the background, and someone was being all dramatic about all the pay cuts that people took. Now, let's think about this. Let's use Howard Marks' second level thinking, right? There's more to it than this. If you are one who has a mortgage that you wrote 5 years ago at 3%, that has cars that are paid off or maybe were purchased a while back, et cetera, you could be significantly better off with high inflation. The relative cost of that person's mortgage is a lot cheaper. It's a lot less of their income, even if their salary only increased by 5 or 6%, because they have a fixed rate mortgage at 3%. So it's not as simple as like this first grade journalism. Oh, the world is ending. Things are more expensive. Now, there are other people who don't own a home, don't own a car, didn't get a pay raise this year and are seeing the cost of food, the cost of shelter, all these things go up, they're probably significantly worse off. But I just don't think it's as simple as this gets presented on the nightly news.
I agree on it not being simple, and it's really tricky to discuss for the bifurcation that you just laid out. One thing that's interesting, and this I'm going to say this from an academic standpoint, not a human on the ground standpoint, because it can feel really different. If you look back over the past roughly 100 years, a little bit over, and look at inflation changes, typically inflation is, in the modern era at least, is lower than what pay raises for that year are, typically. Now, again, that depends all on jobs, and there's so much in the nuance, and so I'm saying that generally from the academic sense. Then you have these very rare, which you've pointed out before, but really rare high inflation circumstances. And by rare, it's happened 4 times in the last 100 years, 100-ish years. World War I,
in
World
the
War
US.
II, in the US. We're talking US here. This is all US. And so when inflation gets this high, this kind of thing will pop up, right? It says, but wage growth is under inflation, and so I'm losing money. But when wage growth is over inflation, no one says anything. And most of the time, depending on your job, right, inflation is a lot lower. And so it's really tricky, right? But to the second category of folks, getting to the human level again, the second category of folks you're talking about, if you're living paycheck to paycheck, even when wage growth might be higher than inflation, then when this happens, it's a pretty significant, to use an economic term, externality in your life, right? That can feel really painful. But it's so hard to simplify it to the point of what the article says.
Yeah, so I've been on all sides of this, and 20 years ago, I would have been the employee walking into my boss's office saying, inflation printed at 7.1%, give me a 7.1%, very rigidly, right? Today, I mean, we talked about my company earlier. Today, I'm building the financial strategy for companies that, with the CEO, that have these sort of problems. And so I see the flip side of that, where we're going, yes, we know the employees' costs are up, and we love these employees and we want to be sensitive to them. We absolutely care about being fair to them. But what does my pricing power look like? What is the economy going to do in 2023 that's going to impact my revenue levels? How are my profit margins moving? This, again, sorry, because I sound like a broken record with everything is so complex, but it's just not that simple. Your company might not have the ability to increase their prices by 7.1%. And if they do, they might have some of their top talent that's demanding more than a 7.1% raise. It just can't cascade down to everyone where this gets tied off in a nice little bow and looks perfectly. You have to say, to your point, well, for the last decade, I was fortunate enough to get pay raises that outpaced inflation. And hopefully I was smart about how I spent that money or saved that money or invested that money. Now I'm probably facing a couple of years where I'm on the wrong side of that equation, and I'm going to have to be smart about how I optimize my personal finances.
Yeah. It's tough. It's just not simple. So there's another element of this, which is, I don't know what to call this. I think there's probably a phrase for it, but you basically say it's level setting, right? And sometimes there will be a level that's set that might be set too high, right? And if a level is set too high, like an individual employee, for example, if market rate is X and they're being paid 30 to 40% above X, and then inflation hits, they're like, well, where's my 7% raise? They've actually been paid 30% higher than what the market would say they should have been paid for 2 years. And so what do you do in that circumstance? And sometimes it's also what occurs where, if we're sticking with salaries here for a second, where someone might say, well, this person's there, I'm below there, so bring me up to there. Now you've set a new level. And so when it comes to, as a company, when it now comes to increasing by a percentage basis on that, if your cost basis is already 10%, 15% above what it should be, increasing another 7%, you're basically, as a company, you're trading the future, right? The future viability of your organization potentially. It's just, to your your point, it's really complex. Like it's hard to work through all this stuff. And as an individual, you might go, I don't care if it's complex, that's your problem. You go, well, my problem in the future is all y'all's problem, is what's tough.
Yeah. Yep. Well, and think about again, the company's perspective of your goods, whether they're goods or services, are increasing in price. Your salaries are increasing. And if you don't have that pricing power, you could be a company in your example that has historically paid people 15% over their market value. Maybe you can't be a company that does that anymore because of all the financial challenges that existed in 2022. It's really tough stuff.
Yeah, it's really tough. Thank you,
John. I hope we did that justice. Maybe I made some assumptions about where you're going with that, but I just don't think it's that simple. And I think it's really important to fight for a fair wage. But ultimately, the way you prove that to your employer, if your employer is not receptive to those things, is you find another job or get multiple job offers that want to pay you that 7% more. Because if the market doesn't exist, then it's just a guessing game. So
is that it for 2022?
To put a bow on this, I do think it's going to be next week, Doogles. We're going to do the breakdown of 2023 stock picks, which, oh my, I'm super excited about. I've done some. Can I drop this? Here's what my stock picks look like going into 2023.
Like, did you do like a preliminary screen already or something?
I did a preliminary screen.
Oh, come on.
Ended up with 19 companies that hit the initial list. And then when I did the due diligence, I ended up with only 8 companies, which was lower than I expected because the market has pulled back a little bit. So I expected that list to be higher. Here's some stats on those companies. If you take all 8 of those companies, group them together and do an equal weighting, meaning you'd buy 1/8, you distribute your money 1/8 across all those names. You're looking at a price to book for these deep value picks of 1.1, price to cash flow of 5.3. Anything less than 7 is like screaming deal, typically Doogles. Price to earnings of 5.6, debt to equity of like 0.25. And
look at that.
Even return on equity figures. This is high for the deep value play of north of 20%. So I am so excited to deploy
I'm really
this capital
surprised
in
by that
2023.
one. I'm really surprised
I know.
by that one. That one's high. And I remember, was it last year, like around May or so, and you just like for funsies ran your screen? You're like, nothing's coming up. Like there is no deep value. Oh my goodness.
At the peak of the bubble, I think I had like 2 names hitting. Now I have 8, and man, I am so excited to deploy this capital. So this is another tidbit. I ended up down 17.7% with a quantitative screen that we told the premium subscribers about at the start of 2022. And I'm super excited about that. Just barely beat the total return of the S&P 500. I can't wait for next week. And Doogles, I don't think your screen hits for a couple more days. So you haven't opened your gifts like I have.
Yeah, tomorrow morning.
Just yet. Do you have time blocked on the calendar?
Oh, I've got days. This is just like don't bother me time. It's wonderful. I'm so excited.
So that's good stuff, guys. We are super excited to talk to you next week. We'll do probably a year in review for the non-premium subscribers, and then we'll send out the latest, not recommendations, but we'll let you know how we're deploying our capital because we think that's important to do for the premium subscribers.
Thank you, everybody. It's been a wonderful 20 deuce. I said it again. That's 3 times this year I've said that now. Thanks for another year listening. Looking forward to 2023.
See ya.